Hi, my name is George Stagnino. I'm the editor of the Peter Dack Portfolio Strategy and Management. What I would like to review with this presentation is the impact of the inventory cycle on commodities, stocks, and bonds. I think we have reached a critical point in this cycle, and I think it could drive the markets despite what the Fed is doing. But first of all, I'd like to remind you where we are in the business cycle. This is the period of all the excesses generated from phase one to phase two and phase three. This is where all the excesses are corrected. Rising inflation, rising commodities, rising interest rates, rising inventories, declining profits, all is being corrected in this phase. And that's where we are in. So let's dig in. This is the inventory to sales ratio. And what it shows is this curve, when it rises, it means that inventories are rising faster than sales. So that means that sales are growing less than inventories, which means business is not that good. When, however, the inventory to sales ratio is declining, it means that sales are rising faster than inventory. So that means that business is good and is going to be good. Why? Because business is going to try to produce more to meet the growth in sales. So we had the same thing here in 2018. Then strong economy 2020, and now from 2021-22, we see that the inventory to sales ratio has been rising, meaning that the inventories again are rising faster than sales. So that tells you that at some point business has to be careful and it has to slow down the growth in inventories. Why? Because rising inventory too fast relative to sales, it means that profits slow down and actually in some cases decline. Let's see how. This chart shows two graphs. The first graph is the blue line is personal consumption expenditures. It's a broad measure of consumer spending. And the red line is income. Both lines are after inflation. So you can see from mid-2022, sales have been flat. And the reason is obvious because income, as you can see on a year basis, is actually contracting, it's coming down. So as income is coming down after inflation, consumers are spending less. So what is the impact on business? Well, what business is doing has been ramping up inventories, as you can see the red line, a double-digit pace. And they did not recognize, they tried to meet the strong demand that happened because of the tremendous amount of money thrown at the economy by the Fed and the government. And so they kept on producing a lot, believing that this sales, you see, sales are growing much faster than inventories. So they were trying to catch up with inventories, with sales. So, but what has happened? Obviously, this could not last, growth of 40% from a year ago. So sales slowing down because of rising inflation. And also, as you notice, now income is declining. So sales are coming down and business is finding itself with a lot of inventories. And that means a lot of money. It costs a lot of money to carry all these inventories. But what has happened recently is this. This is very, very important trend. Finally, they're realizing that they have too much inventories. You saw what happened to the stocks of Nike and other retailers when they reported heavy inventories and lower earnings. They started cutting, they need to cut inventories. Now, that's one piece of information. The other one is how far will they have to go? Well, history shows that inventory growth is like the economy. It's like the long term of sales, which is around 3%. Now, inventories are growing at 14%, double digit. So there's going to be a long and protracted decline in a slowdown in inventory growth. What does it mean? Well, let's see what the implications. Well, the reason that business needs to bring inventories down because the two is costing too much money is because profits are coming down. I mean, profits are coming down because of excessive costs that they accumulated because they thought they needed a lot of workers, they needed a lot of raw materials, they needed to borrow money. But the result is that as sales come down and inventories are still growing too rapidly, profits are coming down. So what is business going to do next? Well, you guessed it right. They need to cut production. And this is what is going on from May 2022. This is the decline on a month-to-month basis, industrial production. Here, then went up, here went down again, here went up, this is down, and there's a big decline here. So in the last 1, 2, 3, 4, 5, 6, 7 months, 5 months were decline in industrial production. So what business has decided, in order to keep profits under control, they have to bring down inventories, and they have to take it down from the current pace of growth of 14% year over year to 3%. So this cut in production is going to last a long time. Of course, when you cut production, what do? You need fewer raw materials. So you cut the purchases of raw materials. That's why you see commodity prices from copper, lumber, oil, natural gas, they all peaked here when business decided that they had too much inventories and they had to cut production because they needed less of this stuff. This chart shows two graphs. The red graph is the yield on the 2-year bond note, and the blue line is the interest rate set by the Fed. The point of this chart is that when business decides to increase inventories because of strong demand, they, of course, buy more commodities and commodities rise. They hire more people and wages start going up. And of course, they borrow more and interest rates start rising. What is interesting about this chart is that the Fed started increasing interest rates a year after the market rates started rising. Now, what is interesting about this chart is that when business decides to control inventories and borrow less, interest rates decline, market rates. The Fed recognizes that and tries to match the interest rates as set by the market. What is interesting now is that because of the inventory correction that is now underway, as I discussed in the previous slides, the 2-year yields dropped and dropped below the rate set by the Fed. Historically, when this happens, means that interest rates are very, very close to a top. So this position of interest rates relative to the level of interest rates set by the Fed is very important because it tells you that probably this is a peak in interest rates as it was here and it was as it was in previous instances. We have seen in the previous slides that income has been declining after inflation. Sales have been flat. Now business is cutting production. Of course, raw material prices are coming down. So there is, of course, business, in order to cut inventories, they have to do two things. One is to reduce production. The other thing is to cut prices to get rid of unwanted inventories. So the bottom line is what you see here is that inflation now is declining. Mind you, as I said before, you don't bring growth in inventories from 14% to 3% growth overnight. It's going to take many, many months. So this process that is going on, it will last many months indeed, probably until the end of 2023. Of course, this process has been put in motion by the consumers because of rising inflation. And as you can see from this chart, consumer optimism by the University of Michigan has been declining to unprecedented levels. So that means that consumers will not increase spending until income increases, until interest rates decline, And this means that it will take many months for this to happen. Let me put now what I just said in terms of lead lag relationship, because this gives you a sense of the timing of how things are going to happen and what you should look for. The first thing we saw is that earnings started coming down because of excessive inventories. Then what we saw after a while, production has been slowing down. And of course, what you see also is commodities have been weak. Now, what you have seen the result of these two actions, business decision, now you're beginning to see inflation and interest rates. So we are here. This is just the beginning. So when are earnings going to improve? Well, earnings are going to improve, and the stock market is going to, the new bull market is going to move higher, is when you have inflation coming down, production at very low level, and inventories growing very slowly at around 2-3%. Commodities, of course, already coming down, will continue to go down. Inflation will continue to go down. Only at that point, when sales and inventory growth are roughly the same, then you will see earnings. Finally, earnings are going to improve because of much lower inventories, much lower commodities, wages, and interest rates. Business sees profits improving, and they start ramping up production. The stock market going up. At some point, after roughly, then after earnings start improving, production improves, and roughly after a year and a half from this point, you see inflation and interest rates rise again, and the cycle starts all over again. So what is the bottom line of this presentation? Well, there is going to be a major inventory correction ahead of us. Commodities will decline because business will require fewer raw materials. They have to produce less. They will also require less money. So interest rates and yields, bond yields, are going to decline. During a period of slower growth, as I showed in other presentation, bonds are likely to outperform stocks. When will earnings in the stock market bottom? Well, they will bottom when inventories are in line with sales, which roughly is a growth rate around 2 to 4%. What about the Fed? Well, the way I see it, I know you probably don't agree, but the Fed is a bank regulator, and its main function right now is to finance government programs. As I mentioned to you at the beginning, I am the editor of the Peter Dack Portfolio Strategy Management. By the way, you can check what I write and my work and all my previous issues on www.peterdapp.com, and you will receive a free subscriptions, no credit card needed, by the way. McGraw-Hill Education commissioned this book on profiting in bull or bear market. Has been available in English, of course, and in many languages in the Asian markets. I wrote also Easy Ways to Beat the Market with ETF and Investing Wisely. All my articles, by the way, are available on www.peterdack.com. Thank you again for reviewing this presentation, and I really hope to see you really soon. So long, and have a good year.